Oh, okay. And I wanted to set the scene here. So, Greg, so you understand how we got to where we're at. Um,
Yep.
when I got together with John last fall, there was a number of issues he was concerned with, and one was a lousy relationship with the TPA that's handling the 401k plan, and that's why Norm's here. That's where we
Okay.
started there. Um, but John just has never been comfortable with dealing with the people out of California and wanted to make a change. And we started looking at the plan, and he was thinking he was maximizing his contributions. And we looked into that for a couple of reasons. One, because of from an asset protection point of view, the amount of money he has sitting on the business checking account, subject to creditors. If we get into a qualified retirement plan, we eliminate that risk. And that was
Hmm.
something that was real interesting to him, was to be able to do that. So that was
Yep.
the reason for looking at expanding on the 401k, because he was maximizing it under the standard uh, guidelines and was sidestepping profit sharing for the moment. So then we talked about trying to maximize contributions, and I reached out to Norm, and he put together a cash balance 401k profit sharing combination to maximize those benefits. And we're working with 2024 as a starting point. So we were still able to go back and affect 24. We'll effectively be contributing to 25. And there's some variations to the plan structure that will occur. 24 is come and gone, so there's certain things we can't do. Norm's going to explain that. He's the technical guy.
Okay.
I've been dealing with Norm for, oh God, it must be 25 years, probably
Easily.
at this point, um, with a number of plans that I implement for clients, things like that. So
Okay.
he's the he's got the inside knowledge. I've got the general knowledge. He's got the inside. And I think you see the illustration that
I do. I have it up here. Yep.
cool. Okay.
Awesome.
Um,
Awesome.
so that's the scenario, and I'm going to let Norm go ahead and break that down for you so you get an idea. And Mary's here for educational purposes only
Okay.
and
Well,
questions.
Greg, it's a pleasure meeting you. I hope you can hear me okay.
I can. Yes. Yep.
Awesome. Awesome. So yeah, you took a look at the illustrations. Oftentimes when clients are looking to put away higher levels of contributions than a 401k can provide, right? Then we kind of look at adding on another plan, and that other plan typically falls as a what we call a cash balance plan. And so in this scenario, what we did is we took the census data that we got for 24 and we added on a maximum cash balance plan. So this illustration is really what it kind of shows is how much extra, right, they can put away into the plan, as well as take as an employer deduction. So I'm happy to walk through some of these numbers with you.
Mhm.
I figure we could just start at one end of the spreadsheet and work our way over. Would you
Okay.
rather me share my screen or?
Uh, Whatever was more comfortable for you. I mean, I have your illustration up in front of me on another
Okay,
monitor, so
okay,
I'm
okay.
comfortable with that.
So in a cash balance plan, it's really it's a defined benefit plan, and it's a hybrid between a 401k, right, and a defined benefit plan. It looks and feels like a 401k to employees, but behind the scenes are all the DB calculations that we have to do.
Yeah.
Actuarial calculations that are involved, so on and so forth. The goal here is if you look in the column. When you're looking at the illustration, the top two individuals are what we call highly compensated employees, right? Those are
Mhm.
the ones we're trying to benefit. And then the usually below those, in this case here, the following two, they're non-highly compensated employees, just normal employees who don't own any of the business or don't earn more than a certain percentage, So in the very first column, this is the compensation figures that we use for 2024. That was what was provided.
Mhm.
And so based off of that, that's how the calculations start, right? And so if you look in the, oh, I think I have the wrong illustration. I've got the wrong illustration. Hold on a second. let me
Okay.
go. Let me go pull up the correct one here. Apologize.
Which one is it, Norm? Because I want to be sure I'm looking at the right one. I
Yeah,
just,
I think
just
I think
I was
yeah,
about
I
to
think
send it to you, Mary.
Mine says illustration 2024-1.
Yeah, hold on a second.
I think that's the one, Kevin, you
Yep.
sent.
Yes, that is. You're
Okay.
good.
I may just share it here first for a moment, just so that we're all on the same page.
Yeah.
Literally.
Exactly. Yep. Bear with me. Sorry. A little technical difficulty. Ah, this one's better. This is it right here. Okay, so yeah, as you can see, when we're preparing these, we do a lot of different sizes of illustrations just to make sure we're maximizing what the employer is looking to do. Unfortunately, I pulled up one that was a little on the lesser side of the contributions. So I'll continue my story. So if you look in the first couple columns from the left, right, it says cash balance contributions. The total to the plan is about $462,200. Of which is broken down by both Jonathan and Mary, right, of $230,000 each. That's what they're being credited with in the cash balance plan. So that is significantly higher than what you can do in a 401k. Are you aware of what the 401k limits are?
Yep.
Okay. So that's significantly higher. But you also see that both Timothy and Barrett, right, are also getting contributions. By law, they are required to get what the IRS deems as a meaningful benefit. So in this case here, $1,100 or 1% of their compensation is a meaningful benefit. Now, in order to pass certain compliance tests, right, we have to give those two individuals, Timothy and Barrett, right, a profit sharing contribution. Now we're back to the 401k side of things. So the cash balance plan is really for the owners. The employees do get a little bit of it. But then now on the 401k, which is their existing 401k, we're adding a profit sharing. That profit sharing number is applied to both Timothy and Barrett in a formula that allows us to pass compliance tests. So you can see a couple of columns are kind of in the middle of the page. Timothy and Barrett are getting $38,000 and $31,000 respectively. And that makes us pass the compliance test. And then basically all the way over to the right-hand side of the page is the total allocations. And you can see we're adding in the 401k piece. We're adding in the matching piece that they received. We're adding in the cash balance plan and the profit sharing plan. So in total, Jonathan and Mary are getting about $274,000 credited to their accounts. And then the two individuals are getting $39,000 and $32,000 respectively in their accounts. So in this plan design, it passes compliance tests. It works fine. It works great, actually. The employer is able to put a lot more money away, as well as increase their tax deductions that they're getting on their corporate tax return. I do have that number. So in total, right, the employer contributions between the DB, profit sharing, the match is about $559,000, right? And then obviously the employee deferrals is $61,000 between Jonathan and Mary, and then overall about $620,000 into the plan.
Okay.
Norm, quick question. Is the difference between Barrett and Timothy, is that because of the age?
That's exactly right. Yeah, it's age driven, right? So it's compensation, but their compensation is the same, and it's age. So it's a combination of both.
And is the difference? Oh, I'm sorry.
No, go ahead.
I was just going to say, is the definition of compensation salary, or was it to be salary plus bonus? So what they entirely get?
That's correct. It's their total W-2 income. That's correct.
Thank you.
There are some retirement plans that do allow you, to carve out the bonus when determining or when using the compensation figures. But that involves another test. Once again, we want to make sure it's not discriminatory towards the non-Hileys, right? So ordinarily we don't exclude bonuses, but if it was allowable or it worked in your favor, we definitely would have applied it. Okay. So that's really the scenario, Greg, of how the cash balance plan runs, how it operates. They're stepping into it for 2024, right? The plan design on the 401k kind of has to mirror what's happening in the cash balance plan. And so it was not ideal, and so there are some changes that need to be made to the 401k, which we'll be working with them. One of the changes is that when they have a safe harbor match formula right now. None of those dollars, when we're doing some of this compliance tests for Timothy and Barrett, trying to figure out their minimums, none of those match dollars come into play. We can't use those. Ordinarily, when we have a DB-DC combo plan like this, we use a safe harbor 3%. The 3%, right, allows them to pass the compliance test on the 401k, but we can also use those dollars on the cash balance plan, which allows us to actually scroll some of these numbers. They're a little on the high side right now, but they should scroll down as we modify the 401k document to pair with the cash balance plan.
Which would be 25 or 26 or both?
It would be, yeah, that's a great question, Kevin. So the way a safe harbor is that you must give notice to the employees of when the safe harbor has to apply. You give it 30 days in advance of the plan year. So in other words, for 2025, right, they would have given notice December 1st of 24. Unfortunately, we can't change the safe harbor for 25. It's in place. But we will give notice in December of 25 for the 26 plan year. Okay.
Okay.
Yeah.
Norm, would you just maybe
Quick question. Or go ahead, Mary.
I was just going to say, could you just kind of review what the mandatory annual thing is? At the end of the year, you have to mandatory pay the contribution.
Yes. Yeah. So the DB plan, right, does have a mandatory contribution. It's not discretionary. The profit sharing is typically discretionary, but when you pair it with the DB plan, that's a mandatory contribution. It has to be funded. The IRS wants to make sure that it's funded for at least 3 years, right? It doesn't have to be 3 years consecutive, but at least 3 years in order to be determined as a bona fide retirement plan. Right. They want to make sure that you're not having a good year. You take a tax deduction and then you terminate the plan. Right. They want to make sure that this plan is in existence. The rules have been set that 3 years seems to be OK with the IRS. That if you fund it for 3 years, you're good. Does that answer your question, Mary?
Yes, thank you.
Okay. Yeah.
And I did have a question that wasn't really related to the calculations, but it could be. So our corporate year end ends in March. I don't know if you're aware of that. And at some point recently, the retirement plan, the 401k plan, was changed from a March year end to December.
Yeah, I heard that. Yeah.
Okay. I don't know if that presents any issues with the timing of the calculations, whatever, but I just wanted to throw that out there to make sure that you were aware of it.
Yeah, so the calculations are based off of compensation. The compensations is based off of the plan year, right, which is the calendar year.
Okay.
But the deduction is taken in the year in which the contribution was made. It's kind of an odd situation because you guys typically, when you have a plan like this, both the fiscal year of the business and the plan year, right, run in conjunction with one another.
Right.
You know? Sometimes TPAs will, for the ease of themselves, right, switch it to a calendar year so they can extract that compensation, which is produced, right, from January through December. You know, you're giving out W-2 information.
Right.
So they'll do it for the ease of themselves, you know. If need be, we could always go back to what we had before. I don't know if it makes a difference at this point. but certainly we'll monitor it. But we don't take the easy road as a TPA, right? For our benefit, we take we make the road that's more better for the client. And if it's advantageous to work on the client on an off calendar plan year, then that's what we're going to do.
Okay.
So it's just extracting that data sometimes is tough, right? We would have to gather, right? You're running from April to March. Is that what you said?
Correct.
Yeah. So we'd have to gather the compensation from April through March. So you're crossing over the calendar years, subtracting one, adding in the other.
So if we were to, we have a corporate return that's going to be due for the fiscal year ended March of 25.
Yes.
So we'll probably be filing that sometime in June or July.
Yeah.
Are you saying that this plan could be in place for that period of time?
Yes, absolutely.
Okay.
Yeah. Even if you were on a calendar year too. So in years past, a retirement plan had to be put in place, especially a DB plan, had to be put in place by the end of the calendar year. And so, but with the Secure Act 2.0, they changed that. Actually, 1.0, they changed that to allow you to the due date of your tax return to actually install a plan. We don't like to run it all the way out. That's 7 months out.
Right.
We prefer to do it. We got illustrations, we have conversations. There's a lot of legwork that has to go on ahead of time. But right now we're in a good position, right? You haven't filed the tax returns, or I assume you haven't. And so we're having those conversations. We can have the plan in place, and you'll be able to take the deduction. Yeah.
Okay. Well, that was important to know if we wanted to put something in place for this year. That would certainly start the first year of the 3-year mandatory program. Okay.
Yep.
And how hard is it to terminate one of these plans? I had a little experience with one of my clients in the past that it was a little bit of a nightmare, but you're more knowledgeable about that than I.
So that's a great question. It doesn't come up often, but it's a wonderful question. So terminating the plan, obviously, we want to make sure, and the IRS too, because we're involving a couple of different parties, the Department of Labor, the IRS, and the PBGC, right? That when we go to terminate the plan, obviously we do a board of resolution to terminate it. And then we do the actuarial calculations to make sure that the plan is fully funded, right? You can't terminate a plan until it's fully funded, meaning that, 100% of the benefits have been actuarially accrued in the plan to satisfy those benefits. So there's a little bit of a gyration that goes back and forth. Now, I've had some DB plans where they were underfunded, right? And so in those situations, like an underfunded plan, the highly compensated Mary and Jonathan could not take any distributions from the plan until it's fully funded. But what we typically do when we're doing these calculations, we're giving you 3 different numbers. We're giving you the number to bring it just to the funding amount, the one that brings you just a little bit more over the funding, and one brings you to the fully funded amount, right? And the employer can choose which number they want, depending on their financial situation, as well as how much deductions they're looking to do. So oftentimes I can tell you that the client goes with the minimum, which keeps the plan in funding status, which is fine. Now, if the plan, if we give notice that we're terminating the plan, the process is about 6 months. We do have to, make sure the actuarial calculation is done correctly. When we're going to stop the contribution calculations, which is basically the date that we sign the board of resolution. Then go to the PBGC, have them review the information. Yes, that plan's fully funded. Go ahead and liquidate. So there, it's a little bit of a gyration, but in total, about 6 months to terminate.
Okay.
All right.
All right. No, that sounds familiar. That there was a time lag on when they decided they wanted to terminate before they could actually do so. And this particular client the plan was around for quite a while, so I'm assuming that it was fully funded. What happens, as a worst case scenario, we do this for 1 year and then we start the company. having a bad year, 2, 3 in a row, and we've lost money, and maybe we don't have enough money to fund.
Yeah.
What then?
So that's a great question. There's a couple things we can do, right? We can freeze the benefits, right? In other words, no more benefits will accrue. The plan will stay in place in a frozen state, and we will have to report to the PBGC that the plan is frozen. There is a resolution that has to be done to freeze the benefits, because anytime you change the benefit calculations in a plan, you have to do a board of resolution and make the modification or an amendment to the plan document. So the plan can stay in a frozen state for a period of time, and then we don't typically like to have that go beyond 5 years, but sometimes it does happen. We do like to see that the plan kind of move out of the frozen status and do that. The other thing we can do is we can kind of lower the calculations we're doing here are the maximums, right? We're calculating 100% of compensation for Mary and Jonathan. We can always scroll those dollars down and try to reduce the amount of minimum funding that they have to do. Another piece too is that Kevin works as the financial advisor. We typically like to have a blend, right? Because the earnings also offset some of the contributions that are required. So typically that blend is a 40-60 split, 60% of bonds, 40% stock, right? We just kind of invert that and move the stock market. Hopefully the stock market goes up. And we end up generating more earnings, lowering the contribution amount. So there are a couple of avenues. We did have a dentist practice. We established one DB plan for them in 2019. COVID hit 2020. We had to go back to the IRS, get a blessing because his business had substantially changed. And so we just said, all intentions were good to have this plan fully funded and moving forward, but it's not going to work out. And in that case, the IRS blessed it, and we were able to terminate the plan. So there are avenues.
Was the owner able to get his money out?
What's that?
Was the owner able to get his money out in that situation?
Yes, we were able to bring it up to funding status for that particular year because we froze it right away. And we were within the 100% range of the funding, and we were able to terminate it. But we got the blessing from the IRS ahead of time, so we're good.
Okay.
So there was
if you weren't fully funded, then the owners the highly compensated employees cannot take distributions?
That's correct. Yeah.
Okay.
Yeah. If only the HCs, this is a weird scenario. If only the HCs are taking contributions and not the employees, the plan has to be at a funding status of 110, even higher. Mm-hmm. Typically, when we do a distribution, we're paying out all of the people at the same time, not just the owners. Because there are a couple of owners who sometimes I'm walking away from this business. I want my money. Mm-hmm. That's not how we work, but there is a rule in there because some other plans have done that. Not a good situation.
How do we know what that funding number is?
Oh, we give it to you every year. So when we're doing this calculation, you see the illustration we calculated. That fourth column over cash contribution. So in this case here, right, we calculated $462,000. We're going to give you 3 different numbers, right? We're going to give you the number that is 92%, 100%, and 110%. And the employer will make that decision. In this illustration, right, we just put the fully funded amount. That's the maximum.
You're saying there's options in terms of funding goals. They could take a 90% or 110% and fund it according to that?
That's correct. Yeah. They're given 3 different options, right, to choose depending on their financial situation. So they're having a great year. They want to fully fund it. They send in 110% of the funding requirements. They're having a rough year. It's not working out as well, right? Maybe they do the 90%. Maybe we increase the earnings that year to kind of offset some of that.
Yeah.
So there is some. These plans can be very rigid, but there is some flexibility, and you just have to understand the rules. There is some flexibility in there.
And what about the profit sharing piece for the employees? Are they immediately vested?
Yeah. So the way I understand the plan, right? I haven't gotten the plan document yet. But the way I understand the profit sharing or the 401k plan document is that there's a 6-year graded schedule, meaning after 2 years of work, they're 20%, 3 years, 40%. And then at year 6, they're 100%, right?
Okay.
I think that's what the plan is. I believe both Barrett and Tim have more than 6, but Mary would know better than I would.
Yes, they do.
Yeah. So to answer your question, Greg, yeah, they'll be 100% in that. Yeah.
Okay.
But that is a good point, right? In a design situation, you'll notice that the vesting for a cash balance plan is a 3-year cliff. 1, 2, 3 years, you become 100% vested. And then we have a longer vested period on the profit sharing side. So in a different type of plan, we fund it that way because we're banking on the people not being there 6 years. So we're funding the employees on the profit sharing side and hoping to capture back some forfeitures, if that makes any sense.
Mm-hmm. Yeah. Okay. I guess I had one other question.
Yeah.
What do you think of a plan that's somewhere between where we are now with just a 401k deferral and a company match, and having a discretionary profit sharing plan where we could fund more than we're doing now, but obviously not anywhere near the defined benefit calculation?
So that works fine as well. There's no issue with that. They do have the ability to make profit sharing on their 401k. It's currently there. There's no change there. The reason we put in cash balance plans with a 401k plan are really basically 2 reasons. One, to increase the owner's contribution, or the amount that they are getting credited to their accounts, right? Obviously much higher than a 401k would allow, and then 2, to increase the tax deductions to kind of reduce it. Then I think Kevin kind of brought up another point too, is that maybe having more money of the corporation in a retirement plan, which is protected assets from creditors, that too may be a good scenario in this case.
And also when
That's a very good point. Yeah.
when talking with John about this, and he was telling me that what do you call that account, Mary, where the funds that the QI is holding that he's earning interest on is running at about $100,000 a month. And that will more than enough fund this kind of thing, and isn't necessarily relying on additional other business income to generate. I think he liked the numbers. He was asking about the money put away for the employees, but because they're 100% vested, Norm, if they really wanted that money, right, Mary, that was one of the comments. They're used to getting a bonus and having the money. If they really wanted to at 100% vesting, do we set it up that they have to leave employment to get that money, or can you have in-service withdrawals for them on the profit sharing side?
So they always have, on the profit sharing side, they always have the ability to, there's a couple ways they can take the money, is if that's what your question is, how do they access the money?
Well, how do we offset the fact that they prefer having the money in hand?
Yeah.
But we may not want to be doing that. Or some.
So on a 401k side, right, there are a couple of items to take money out of the plan. Obviously, termination of employment, you can take money out of the plan. You can take money out of the plan at age 59 and a half if the plan allows for it. You can also take money out of the plan if they have a hardship, but that one is kind of a narrow window.
Yeah.
It's only very specific. There is also a very unknown rule, or very, very utilized. It's not utilized very often. It's called a 2-year profit sharing rule. So money that's been put into a profit sharing for at least 2 years can actually be taken out of the plan, regardless of age.
And employment status.
And that's correct. Yeah. It's
written into. That question came up in the close of our conversation the other day. I think Mary was curious about it as well. But I think that Mary, knowing that they could get that money if they wanted it, certainly at 59 and a half, Tim is there.
Yep.
Right? He'd be able to access that money if he needed it
Yep.
and wouldn't pay taxes on it as it sits in here, goes
Right.
into the plan, only if he chooses to take it out, as opposed to a bonus, which is going to be taxable immediately. So we may
Is there any penalty to withdraw?
At 59 and a half, the penalty goes away. So ordinarily, it's an early withdrawal penalty of 10%, right? But
Yep.
that goes away at age 59 and a half.
59 and a half. Okay.
So Timothy might be beyond that at this point.
He is. He's beyond it. Yep.
Yeah.
He'll be 60 in a month.
Okay.
Wow.
Yeah.
Okay.
But Barrett would be subject to the 10% early withdrawal, and then obviously ordinary income tax. Any money coming out of a retirement plan is ordinary income tax. So.
And what's not on here is Tim has decided to start contributing his own funds to the 401k plan too, which is good. And we're going to try to encourage Barrett to do the same thing.
Correct.
That brings up another point too, and I'm glad you brought that up, Kim, because I was telling Greg, kind of how we can kind of make these numbers a little bit better for the employer, right? And that's one of them. When employees make 401k contributions to their own account, right? We're using those numbers in part of the calculation to make sure it passes compliance, right? In this case here, they had no contributions on their behalf, so we're not able to utilize those. So if we can get them to start contributing to their 401k, yeah, the numbers may be even better.
Okay.
Yep. Tim's ready to contribute whenever we get him going.
Awesome.
And we'll see what we can do about Chris.
I mean, as you can see from the illustration, right, all the way over to the right-hand side, about 88% is of the funding is going into the two owners' accounts. We like to get that number closer to 90, and I think having those individuals contribute to their 401k, changing the safe harbor from safe harbor match to safe harbor non-elective, we're going to be closer to that 90% range.
What would happen if any one of the employees retired at some point during the mandatory funding phase?
Yeah. So an employee has to be employed on the last day of the plan year and have 1,000 hours. Now, there's one other caveat too, right? And at least 70% of the employees have benefits. So in a lower number plan like this, right, that kind of 70% rule affects them. So when you look at, I'll just work through the test real quickly for you. Mary and Jonathan, right? There's two Hileys benefiting. That's 100%. That means 70% of the non-Hileys would have to benefit. Well, if you have Timothy and Barrett left, right, only one out of the two non-Hileys would benefit. That's 50%. So Barrett would be by default coming back in to the plan. We'd have to give him a contribution for the year that he terminated. Ordinarily, we don't like to do that, but if it fails that 70% rule, then we have to.
I see.
But, I mean, if we brought in another employee, maybe even a younger employee, because these plans work ideal when the age group between the Hileys and the non-Hileys is really large,
Right.
We brought in another younger employee, brought that person to the plan, then yes, Barrett would be extracted, right? Would not get a contribution. The new employee would get a contribution. So.
Okay.
All right. So when I did the calculations, you've worked with a client. Do my compensation numbers look fairly accurate, very close?
Yeah, I mean, I haven't looked at it recently, but those numbers seem reasonably okay. I know they don't include bonuses, those numbers right there. So we generally have bonuses that make compensation much higher than that.
Okay. For Mary and Jonathan, or for?
Yeah, for Mary and John, and to a much lesser extent, Tim and Barrett.
Yeah, and that is why I originally asked, is it off compensation plus, I mean, salary plus bonus?
It's based off of what their W-2 said, whatever
Mm.
their W-2.
Those
Are the
numbers are-
W-2s?
Those are pure salary numbers for all four?
Those are, no, salary for, nope, for none of us.
So that it's more than your salary. Yes, Mayor?
What's that? What's
Those
that?
numbers-
Kev?
Those numbers are more than salary, or those are salary?
No, salaries are less, but they don't include all the bonuses. I don't
Okay.
know where those numbers came from.
Oh. Well, that is that is important.
Yeah,
The illustration, we want to be close, right? I can after this, Mary, I can kind of send you a census request if you wanted to fill it out and just put in the W-2 amounts.
Yep.
I want to make sure. Yeah, I mean, this is a mandatory contribution. We have to make sure we're spot on. So I just kind of want to make sure we get the right numbers.
Yeah, that's a good point to have this updated with the actual 24
Yes.
W-2 amounts.
Correct.
Because
those
I'm just
numbers,
looking
I
at,
believe, I think those are the numbers that came from California,
Oh,
from the
Okay.
TPA. And it may have been
Oh.
23 as opposed to 24. But we can get the proper numbers. And that won't necessarily change things, because if you're going to fund for a smaller percentage, because the salary is a lot higher, then your contribution is going to be lower anyway, right? Norm?
well, we're basing the DB calculation for Mary and Jonathan, right, off of
Yep.
100% of whatever their compensation figure is.
Right,
you
and
know?
based on this 230,000 comp, you're 100% X. Well, if your compensation is actually 430 each, you can do half. You can do 50% and end up in the same numbers.
You could, yes,
Yeah, not
yes.
that it's a goal, but it's how it would balance out. But let's get the proper numbers so we have a.
And that's a good point, Kevin. So when I did, I remember I started off the conversation with another illustration. I did several other illustrations too, right, to make sure, because sometimes the numbers are too high for clients, so I end up backing it down. So I have those prepared ahead of time. But yeah, let's start off with the right compensation numbers, and we'll tighten up these numbers right here.
Good.
But I believe the information for all the way to the right-hand side, which is the 401k deferrals and the match, I believe I got that from the actual 5,500. It was filed for the plan, so I have that. I have those dollars.
Okay. Greg, other questions?
No, for me, I'm good.
no, I think that was it. Yeah, would be good to see this updated with the actual comp numbers for 24, including bonuses.
Yep, for sure.
Because I think that'll change things. And well, and the other thing too is that we did bonus numbers in March of this year to kind of kill a little bit of the corporate profit already. So we'd have to decide between what we did there plus a large deduction like this, would we need that much? And so that'll kind of, having that updated number is going to be very important.
Yep, good.
Yep, shouldn't take too long. I can send that off to you, Mary. Just complete it and then send it back to me, and then I'll have the actuary re-crunch the numbers. Shouldn't be a problem at all. Easy.
Okay, so you want
Sure.
year-end 2024 W-2s?
Yeah. Yep. That'll work. I'll
Are you
send
going
you
to send W-2s, Mary, or do you just need the amounts?
Just the
Because
amounts.
probably need to take, probably box 5 Medicare wages rather than the box
Cool.
1.
That's correct. It's not box 1. Yes.
Okay.
Yep.
Box 5 weight number?
Yep.
Yeah.
Okay. I will do that.
Cool. We'll get that done.
Is it box 5 or is it Greg, or is it box 3? What's box 3? I don't
Box
have
3
it.
is Social Security wages and 5 is Medicare
Oh.
wages.
Okay. All right.
So Social Security wages will max out for John and Mary. So
Right. Yeah. We want the higher
need
number.
total compensation without deductions for 401k and anything else, right?
That's correct. Yeah.
Okay. So yeah, I think that would be box 5, if I
Okay.
remember my boxes correctly.
Yeah, I don't remember the boxes. But yes, I need the total amount.
Yep.
All right.
Okay, good.
All right.
All right.
What do you think,
Thank you,
Norm?
thank you.
We'd be able to have
Thank
those
you.
numbers early next week, John? Or Norm?
Yeah, oh, yeah. Yep.
Yeah.
If you
We'll
want
get
to give me the
them- get
census
them to you
back,
right
I'll
away,
get them
Greg.
off. All right. Yeah,
Alrighty.
we can reschedule another call early next week and just kind of go back over the refined numbers.
Yeah, okay.
All right.
Greg?
Thank you all.
All
Thank
right,
you very
thanks,
much, everybody. Thanks
Mary,
for your
I'll send
time.
the recording along.
All right, thanks. Have
Have a
have
great
a
day.
great weekend. Bye.
All
Bye,
right. Bye.
guys.